Picture this. You've just lost 3 trades in a row. Your palms are sweating, and you're about to make the biggest mistake of your trading career. What happens next will determine whether you join the ranks of successful traders or become another casualty of the market's psychological warfare. Today, we're exploring the fascinating world of trading psychology through Brett Steenbarger's revolutionary book, The Psychology of Trading. This isn't just another trading manual filled with chart patterns and technical indicators. Instead, we're diving deep into the mental game that separates winning traders from losing ones. Trading psychology forms the very foundation of trading success. Think about it for a moment. You could possess the world's most profitable trading strategy, but if you cannot manage your mindset effectively, you will struggle to execute it when it matters most. Steenbarger introduces us to a powerful concept called the performance curve, which serves as our roadmap for understanding how emotions influence every single decision we make. Picture this performance curve as a bell-shaped mountain. At the peak of this curve, you find yourself in what athletes call the zone. You're focused, calm, and making rational decisions based on solid analysis rather than emotional impulses. However, if you slide too far down either side of this curve, everything starts falling apart around you. When you experience too much stress or excitement, you become prone to making impulsive decisions that can destroy your trading account. Conversely, when you feel too little emotion, you become disengaged and miss golden opportunities that could have been profitable. The secret to trading success lies in striking that perfect balance and staying as close to the peak as possible. Let's talk about those emotions that every trader faces daily. Imagine you've just taken a significant loss on what seemed like a sure thing. Your first reaction might be anger, frustration, or even panic. You feel an overwhelming urge to recover that loss immediately, which leads most traders down a dangerous path called revenge trading. Steenbarger emphasizes that emotions like fear and greed aren't just problems to be eliminated. These emotions actually serve as valuable signals about your psychological state. Fear might be telling you there's risk you haven't properly accounted for in your analysis. Greed might indicate that you're becoming too confident or using too much leverage. The key lies in learning to listen to these emotional signals without allowing them to control your trading decisions. This sounds much easier than it actually is in practice, but it's absolutely possible with the right approach and consistent effort. Now let's bring this performance curve concept into practical application. Think about your most successful trades and try to remember what mindset you were in during those moments. Chances are you felt calm, confident, and completely focused on your analysis. That represents the sweet spot at the top of the performance curve. Here's the challenging part. Emotions don't remain static throughout your trading day. One minute you're calm and making rational decisions, and the next minute you're panicking because the market has turned against your position. Steenbarger points out that recognizing when you're sliding down either side of the curve represents the first crucial step toward managing your emotional state effectively. For example, if you notice yourself feeling overly confident after a winning streak, that should serve as a red flag. Being too confident typically leads to taking bigger risks, and bigger risks often result in bigger losses that can wipe out previous gains. On the flip side, if you find yourself at the bottom of the performance curve feeling anxious or uncertain, you become less likely to take good trading opportunities. Instead, you'll hesitate, second-guess yourself, and miss profitable setups that align perfectly with your trading strategy. Let me share a story that illustrates this concept perfectly. There was a trader named John who possessed incredible talent at analyzing market conditions, but he couldn't keep his emotions under control. After experiencing a losing trade, he would spiral into doubt and either stop trading completely or go all in on a risky trade to try recovering his losses. Steenbarger worked with John to help him understand his personal performance curve. They maintained a detailed trading journal that tracked not just the trades themselves, but also the emotions John experienced throughout each trading session. Over time, John began to recognize clear patterns in his behavior. He realized that after 2 or 3 winning trades, he would become too confident and increase his position sizes dramatically. This excessive confidence consistently led to making costly mistakes that erased his previous gains. By identifying this specific pattern, John was able to adjust his behavior and stay closer to the peak of his performance curve. This story demonstrates that trading isn't just about analyzing charts and market conditions. It's fundamentally about understanding what's happening in your own mind. The market acts like a mirror, reflecting your psychological strengths, weaknesses, and emotional tendencies back at you. If you want to improve as a trader, you must start by improving your understanding of yourself. Here's a practical approach you can implement immediately. Start keeping a comprehensive trading journal that goes beyond just recording your trades. Write about how you felt during each trade. Were you nervous, too confident, or stressed? Over time, you'll begin to see patterns emerge, just like John did. Once you can identify these patterns, you can work on breaking the destructive habits while reinforcing the positive ones. Trading psychology forms the foundation of everything else in your trading career. Without mastering this mental game, even the most sophisticated strategies will eventually fall apart under pressure. Steenbarger's approach sets the stage for understanding yourself as a trader and using that knowledge to improve your performance consistently. Moving forward, we need to explore the specific psychological challenges that traders face every single day. These challenges go far beyond simple fear and greed, extending into complex emotional and cognitive territories that can derail even the most prepared traders. Trading psychology feels incredibly difficult because trading itself is unlike any other profession or activity. The market operates like a pressure cooker that amplifies your fears, magnifies your insecurities, and tests your patience in ways you never imagined possible. Consider this reality. Every trade you make represents essentially a judgment call about an uncertain future. That uncertainty can be absolutely terrifying for most people. Your emotions don't just impact your performance, they actually define it completely. When you're stressed, fearful, or too confident, you're significantly more likely to make poor decisions that cost you money. Stress represents the invisible weight that crushes trading success. It's particularly sneaky because it doesn't just appear during bad trades. Instead, stress builds up gradually over time, creating a cumulative effect that can be devastating to your ability to make good decisions. Steenbarger highlights that stress in trading comes from two primary sources. First, there's the constant uncertainty of market conditions. Markets are inherently unpredictable, and living in that constant state of not knowing what comes next can slowly eat away at your mental stability. Second, there's the constant risk of financial loss. Even if you're intellectually comfortable with the risk you're taking on paper, the emotional toll of seeing red numbers on your screen creates real psychological pressure that affects your judgment. Stress becomes particularly dangerous because it narrows your focus dramatically. When you're under stress, your brain automatically enters survival mode, which means you're primarily thinking about immediate threats rather than executing your strategy over the long term. In trading terms, this stress response causes you to focus almost exclusively on immediate losses and gains rather than sticking to your carefully planned strategy. Let me give you a concrete example of how this plays out in real trading situations. Imagine you've had a rough week of trading and you're currently down 10% on your account. The next time you see a potential setup, you feel so stressed about making up for those losses that you jump into the trade without conducting your usual thorough analysis. This emotional process for making decisions driven by stress often leads to even larger losses. Fear represents another major challenge that manifests in many different forms. You might experience fear of losing money, fear of missing out on opportunities, or fear of being wrong about your market analysis. Each type of fear can be equally destructive to your trading performance. Steenbarger explains that fear typically leads to two extreme behavioral patterns. The first is paralysis, where you hesitate to take trades because you're too scared of losing money. This hesitation means you miss out on legitimate opportunities, and over time, your confidence takes a significant hit. The second extreme is impulsiveness, where fear actually makes you act too quickly without proper analysis. For example, you might close a profitable trade too early because you're scared of a small pullback, only to watch the market continue moving in your favor afterward. Here's something important to understand. Fear isn't inherently bad for traders. It's actually your brain's natural way of telling you to be cautious in potentially dangerous situations. The key is learning to acknowledge fear without letting it dictate your trading decisions. Steenbarger emphasizes that successful traders don't eliminate fear entirely. Instead, they learn to work with it effectively, using it as valuable information while maintaining their ability to execute their trading plans when appropriate opportunities arise. Now let's examine the other side of the emotional spectrum, being too confident. If fear represents being too cautious, excessive confidence represents being too reckless with your trading capital. This typically shows up after you've experienced a winning streak and start feeling invincible. You've made several great trades, your account balance is growing, and suddenly you feel like you can predict every market move. This leads to taking bigger risks, ignoring your established risk management rules, and chasing trades you wouldn't normally consider viable. Steenbarger calls this the euphoria trap, that dangerous feeling of invincibility that blinds you to the reality of market risk. Let's be honest, this trap has caught virtually every trader at some point in their career. The market has a way of humbling us quickly when we become too confident. One significant loss is typically all it takes to bring overly confident traders back to reality. Here's a practical tip from Steenbarger. Whenever you feel too confident, take a step back and examine your recent trades objectively. Were they successful because of your superior skill, or did market conditions simply happen to align in your favor? This kind of honest reflection can save you from the confidence spiral before it destroys your trading account. Remember, the market doesn't care about your recent winning streak. It will test your discipline and risk management skills regardless of your past performance. Beyond emotions, your brain has its own set of cognitive tricks that can derail your trading performance. Steenbarger explains several cognitive biases that traders commonly fall victim to, often without even realizing it's happening. Confirmation bias occurs when you only pay attention to information that supports your existing beliefs about market direction. For example, if you're bullish on a particular stock, you might ignore bearish signals that contradict your predetermined opinion. Recency bias happens when you give too much weight to recent events while ignoring trends that span longer periods. If the market has been rallying for a week, you might assume it will continue rising indefinitely, even though the trend over many months suggests otherwise. Loss aversion represents the tendency to fear losses more than you value equivalent gains. This bias explains why traders often hold on to losing positions for too long, hoping they'll turn around instead of cutting losses early and moving on to better opportunities. Recognizing these cognitive biases represents the first step toward overcoming their influence on your trading decisions. Steenbarger suggests keeping track of your thought processes during trades and regularly checking for these biases. Over time, you'll start catching them before they influence your process of making decisions. Now let's discuss practical solutions for handling these psychological challenges. Managing emotions and cognitive biases isn't about eliminating them entirely. That's impossible. Instead, it's about developing effective strategies for working with your psychology rather than against it. Creating a daily trading routine can help reduce stress and keep you mentally grounded. This routine might include reviewing your trading strategy, setting clear goals for the day, and taking regular breaks to maintain mental clarity. Maintaining a comprehensive trading journal serves multiple purposes beyond just tracking your trades. Write down how you felt during each trade and look for emotional patterns over time. This awareness helps you identify triggers before they sabotage your performance. Practicing mindfulness techniques might sound unconventional, but they can significantly help you stay calm and focused, especially during volatile market conditions. Simple breathing exercises and brief meditation sessions can reset your mental state when emotions run high. Setting realistic expectations prevents you from falling into common psychological traps. Don't aim to win every single trade or double your account in a month. These unrealistic expectations lead to stress and excessive confidence. Instead, focus on consistent small gains that compound over time. Understanding your personality traits and how they influence your trading style represents another crucial aspect of trading psychology. What works perfectly for one trader might completely fail for another because we're all wired differently psychologically. Steenbarger explains that your natural tendencies, strengths, and weaknesses play a massive role in how you approach trading decisions. Think about it. Are you someone who thrives under pressure, or do you freeze up when market conditions become intense? Do you take risks easily, or are you naturally more cautious in your approach? These aren't just random personality quirks. They're reflections of your psychological makeup that directly influence your trading behavior and ultimate success or failure in the markets. Risk tolerance varies dramatically between different personality types. Some people are natural risk takers who thrive on adrenaline and aren't afraid to take large positions. Others are more cautious about risk and prefer to play it safe with conservative position sizes. Neither approach is inherently superior, but here's the critical point. If your trading strategy doesn't align with your natural risk tolerance, you're setting yourself up for psychological stress and poor decision-making. Let me illustrate this with a practical example. Say you're naturally a cautious person, but you're trying to day trade with high leverage because you think it will make you money faster. This fundamental mismatch between your personality and your strategy will create anxiety, causing you to second-guess your trades constantly. Conversely, if you're a natural risk taker, but you're forcing yourself to use an extremely conservative strategy, you'll likely get bored and start taking impulsive trades that don't align with your system. The key is matching your strategy to your personality rather than fighting against your natural tendencies. Emotional resilience represents another crucial personality trait that affects trading performance. Trading is emotionally draining, and you'll face losses, doubt, and frustration regularly. If you naturally bounce back quickly from setbacks, you have an advantage. However, if you tend to take losses personally, the psychological road will be more challenging. The good news is that emotional resilience can be developed over time through practice and proper mindset training. It's not a fixed trait that you're born with or without. Your style for making decisions also plays a significant role in your trading approach. Are you analytical by nature, preferring to see concrete data before making decisions? Or are you more intuitive, relying on gut feelings and instinct to guide your choices? Both analytical and intuitive approaches can work effectively in trading, but you need to be aware of which style suits you best. If you're naturally analytical but trying to trade based on intuition, you'll feel chaotic and stressed. Similarly, if you're intuitive but forcing yourself to analyze every piece of data, you'll feel paralyzed and miss opportunities. To identify your psychological strengths and weaknesses, start by examining your trading history carefully. Ask yourself these important questions. What types of trades do you excel at consistently? When do you tend to make your biggest mistakes? How do you feel during your most successful trades? By answering these questions honestly, you'll start identifying patterns in your behavior. Remember, don't focus exclusively on your weaknesses. It's equally important to understand your strengths so you can build upon them effectively. For example, if you're excellent at spotting trends that span long periods but struggle with day trading over short periods, focus on swing trading or position trading where your natural skills shine. Trading success comes from playing to your strengths rather than fighting against your natural psychological tendencies. Ignoring your personality in favor of copying other successful traders represents a dangerous mistake. Maybe you see someone making incredible profits with scalping, so you think you should try the same approach. However, if scalping doesn't align with your personality, you'll struggle, feel out of sync, make mistakes, and lose confidence. The most successful traders don't copy others blindly. Instead, they understand themselves deeply and tailor their strategies to fit their unique psychological makeup. This awareness represents the real secret to trading success over the long term. Now let's explore cognitive techniques that can enhance your trading performance. Whether you've struggled with distractions, fallen victim to cognitive biases, or let emotions interfere with your trades, these techniques can help you sharpen your mental edge. Trading is fundamentally a mental game. You need technical strategy and market knowledge, but if your mind isn't clear and focused, even the best setups can fail. Your ability to concentrate and think logically under pressure separates consistent traders from those who struggle. Creating a trading environment free from distractions is essential for maintaining focus. Distractions are everywhere in our modern world. Phones buzzing, social media notifications, random thoughts popping into your head during important trades. Set up a dedicated trading space that's clean, quiet, and free from unnecessary distractions. Setting clear intentions before each trading session helps maintain focus throughout the day. Before you even look at the markets, take a moment to clarify your goals. What are you trying to accomplish today? What specific setups are you looking for? By establishing your focus ahead of time, you're less likely to get sidetracked by impulsive decisions. Practicing mindfulness isn't just a trendy concept, it's a proven method for staying present and focused. Simple techniques like deep breathing or short meditation sessions before and during trading can help you maintain emotional equilibrium and mental clarity. Overcoming cognitive biases requires conscious effort and systematic approaches. Confirmation bias can be countered by always challenging your assumptions. Ask yourself what evidence would prove your current market opinion wrong. This keeps your analysis balanced and objective. To combat recency bias, always zoom out and consider the broader market context. Look at longer time frames and historical data to get a perspective that covers more ground rather than focusing exclusively on recent price action. For loss aversion, try reframing your mindset about losses. Instead of fearing them, view controlled losses as a normal part of the trading process. A small, controlled loss is simply a stepping stone toward profitability over the long term. Dealing with emotional interference requires acknowledging your emotions rather than suppressing them. When you feel anxious, too confident, or frustrated, don't try to ignore these feelings. Instead, take a moment to recognize what you're feeling and why you're feeling it. Using structured breaks during emotional moments can help reset your mental state. If you feel overwhelmed during a trading session, step away from your computer. Take a short walk, do some stretching, or practice deep breathing. When you return, you'll be in a much better position to make rational decisions. Developing emotional resilience involves maintaining a growth mindset about your trading journey. Instead of viewing losses as personal failures, see them as learning opportunities that provide valuable feedback about your strategy and psychology. Visualization techniques can significantly improve your trading performance. Before you start trading, spend a few minutes visualizing yourself performing at your best. Picture yourself calmly analyzing market conditions, confidently executing your strategy, and managing trades with complete discipline. Mental rehearsal involves walking through specific scenarios in your mind before they happen. For example, imagine how you'll react if a trade goes against you or how you'll handle a winning streak. By mentally preparing for these situations, you'll be less likely to panic when they occur in real trading. Setting goals that focus on process keeps you focused on what you can actually control. Instead of focusing solely on monetary outcomes, set goals related to following your trading plan perfectly or maintaining detailed trade records. Goals based on process reduce stress and improve performance because they emphasize controllable factors. Developing disciplined routines represents another crucial aspect of trading psychology. Successful trading isn't just about skill or strategy, it's about consistency. And consistency comes from disciplined habits rather than motivation alone. Creating a routine before trading helps prepare your mind and environment for optimal performance. Start by reviewing your trading plan and identifying what setups you're looking for today. Check broader market conditions, analyze key economic news, and review technical indicators. Finally, take a few minutes to center yourself mentally through breathing exercises or brief meditation. Sticking to a consistent trading schedule creates structure and reduces emotional decision-making. Whether you trade during the full day or part-time, having specific hours dedicated to market analysis and trade execution creates professional discipline. Developing habits after trading is equally important. After the markets close, review each trade you made. Did you follow your plan exactly? What went well and what needs improvement? Write down not just the technical aspects, but also your emotional state during each trade. The power of visualization extends beyond simple positive thinking. Your brain doesn't fully differentiate between real experiences and vividly imagined ones. When you visualize yourself trading successfully, you're actually conditioning your mind for real success. Mentally rehearsing difficult scenarios prepares you for challenges before they arise. Visualize how you'll handle a trade going against you, how you'll manage a losing streak, or how you'll resist the urge to chase trades after missing an entry. This mental preparation trains your mind to stay calm under pressure. Turning these techniques into permanent habits requires starting small and building gradually. Don't try to overhaul your entire routine overnight. Start with one or two small changes and build on them as they become automatic. Using triggers can help maintain consistency. A trigger is something that reminds you to perform a specific habit. For example, set an alarm 15 minutes before market open to remind you to start your routine before trading. Tracking your progress helps maintain motivation and accountability. Keep a record of your routines and habits, and celebrate small wins along the way. Whether it's sticking to your trading plan for a week or completing a full month of detailed journaling, acknowledge your progress. Managing emotions like stress, anxiety, and frustration while building resilience represents perhaps the most crucial aspect of trading psychology. These emotions are natural human responses, but they can cloud judgment and lead to costly mistakes if not managed properly. Stress management begins with identifying your personal stress triggers. Pay attention to what situations cause you to feel overwhelmed or anxious. Common triggers include fear of losing money, pressure to perform, or trying to recover from losing streaks. When stress levels spike, your body activates survival responses that are terrible for rational decision-making. Learning relaxation techniques becomes essential. Deep breathing exercises, progressive muscle relaxation, and mindfulness practices can quickly reset your nervous system. Anxiety often stems from focusing too much on outcomes rather than process. Instead of obsessing over whether you'll make money on a specific trade, focus on executing your plan perfectly. Remember, you can't control market movements, but you can control your actions and responses. Reframing your mindset about losses is crucial for managing anxiety. Losses are simply part of the trading business, not personal failures. Instead of seeing a losing trade as a disaster, view it as feedback about your strategy or market conditions. Frustration typically hits when trades don't go according to plan, even when you followed your strategy perfectly. The key is pausing before reacting emotionally. When frustration strikes, step away from your computer for a few minutes to regain composure. Channeling frustration into improvement rather than destructive behavior turns negative emotions into positive growth. Ask yourself what you could have done differently and whether there are patterns in your frustration that point to specific areas for improvement. Building emotional resilience involves developing the ability to bounce back quickly from setbacks. This isn't about staying positive all the time. It's about maintaining perspective and using challenges as opportunities for growth. Practicing compassion toward yourself means treating yourself with the same kindness you'd show a good friend. Stop beating yourself up over mistakes and instead focus on learning from them. This compassion reduces negative thoughts about yourself, which is a major barrier to emotional resilience. Developing a growth mindset transforms how you view your trading journey. Instead of viewing challenges as barriers that cannot be overcome, see them as opportunities to learn and improve. This shift in perspective is crucial for long-term success. Maintaining a positive mindset doesn't mean ignoring reality or pretending everything is perfect. It means staying optimistic and focused even when facing challenges. Focus on celebrating small wins, controlling what you can influence, and using positive affirmations to program your mind for success. Developing a comprehensive trading plan integrates all these psychological strategies into a practical framework. A structured trading plan isn't just about entry and exit points. It's about creating a roadmap that guides you through market ups and downs while keeping emotions in check. Your trading plan should include clear goals and objectives. Are you trading for steady income, building wealth over the long term, or something else? Having clear purposes gives your trading meaning and direction, making it easier to stay disciplined during difficult periods. Setting specific entry and exit criteria removes guesswork from your trading decisions. Define exactly what technical indicators, chart patterns, or market conditions you're looking for before entering trades. Equally important, establish clear exit strategies for both profitable and losing positions. Risk management represents the foundation of any successful trading plan that cannot be negotiated. Determine how much capital you're willing to risk on each trade, how you'll size positions, and how you'll handle losses before they become catastrophic. Incorporating emotional control strategies into your trading plan is just as important as technical analysis. Plan for your emotional responses by setting rules for when to take breaks, how to handle losing streaks, and techniques for staying calm during volatile periods. Using visualization to reinforce your trading plan makes it more likely you'll follow through during stressful moments. Before each trading session, spend a few minutes visualizing yourself calmly executing your plan without making impulsive decisions. Building accountability into your plan helps maintain discipline when willpower alone isn't enough. Find a partner who can hold you accountable, join a trading community, or work with a mentor who can provide feedback and keep you on track. Staying flexible within your structured plan allows for adaptation as market conditions change. This doesn't mean abandoning your plan when things get tough. It means making minor adjustments based on what's working while maintaining core principles. Coaching yourself represents the ultimate tool for continuous improvement in trading psychology. Rather than waiting for external feedback, coaching yourself puts you in complete control of your growth and development as a trader. Coaching yourself starts with brutally honest reflection. Ask yourself tough questions about your trading performance, emotional patterns, and areas for improvement. Are you following your plan consistently? What emotions do you experience before, during, and after trades? Creating a comprehensive trading journal serves as your primary tool for coaching yourself. Record not just your trades, but also your process for making decisions, emotional state, and lessons learned. Over time, this journal reveals patterns you can't see in the moment. Setting clear, achievable goals for improvement keeps you focused on continuous growth. Break down big goals into smaller, measurable steps that you can track and celebrate. Focus on process improvements rather than just monetary outcomes. Regular progress reviews help you stay on track and adjust your approach as needed. Schedule weekly or monthly sessions to review your trading journal, assess your emotional patterns, and identify areas that need attention. Developing a routine for managing emotions gives you concrete tools for handling psychological challenges. This might include meditation before trading, techniques for stress relief during volatile periods, and reflection after trading on emotional highs and lows. Building accountability into your program for coaching yourself can involve working with mentors, joining trading communities, or simply sharing your goals with trusted friends. Having external accountability makes it harder to abandon your development plan when motivation wanes. Studies of real-world cases provide powerful examples of how trading psychology plays out in practice. These stories illustrate both common pitfalls and successful strategies for overcoming psychological challenges. Consider the trader who struggled with impulsive decision-making. After every market dip, fear would cause him to panic and sell positions too early. During market surges, excessive confidence led to too much leverage and dangerous position sizes. The solution came through developing strict adherence to trading rules that were set in advance and maintaining detailed emotional journals. Another case involved a trader whose early success bred dangerous levels of confidence. A good run of profitable trades inflated her ego, leading to bigger risks and ignored risk management principles. The market eventually humbled her with substantial losses, teaching the importance of maintaining humility and respecting market unpredictability. A third example featured a trader who faced emotional devastation after major losses. Instead of falling into despair, he used setbacks as learning opportunities, working with a mentor to build emotional resilience and develop healthier perspectives on failure and success. These stories demonstrate that psychological challenges are universal among traders, but they can be overcome through discipline, awareness of yourself, and consistent application of proper psychological techniques. The role of intuition in trading deserves special attention because it represents a different kind of market analysis. Intuition isn't magical thinking. It's the result of experience, pattern recognition, and processing of market information that happens below conscious awareness. Distinguishing between intuition and emotional impulse is crucial. Intuition feels calm and grounded, like a quiet inner voice guiding your decisions. Emotional impulse is loud and urgent, pushing you toward immediate action without logical reasoning. Developing intuitive skills requires extensive market experience and mindful observation. The more time you spend studying market behavior, The better your brain becomes at recognizing subtle patterns and signals that conscious analysis might miss. Trusting your intuition takes courage and confidence that develop over time. This means overcoming fear of making mistakes and learning not to overthink every decision. Sometimes the quiet certainty of intuition provides better guidance than endless analysis. Risk management from a psychological perspective involves much more than calculating position sizes and setting stop losses. It's about managing the emotional challenges that come with uncertainty and potential losses. The fear of losing money represents the biggest emotional challenge in risk management. This fear can lead to paralysis where you hesitate to take good trades, or impulsiveness where you exit positions too early to avoid discomfort. Excessive confidence and greed create opposite problems, leading to taking too much risk and ignoring safety measures. After winning streaks, traders often increase position sizes and abandon conservative approaches, setting themselves up for major losses. Maintaining discipline in risk management requires having clear rules and sticking to them regardless of emotional pressure. This means setting specific parameters for ratios between risk and reward, position sizing, and levels for stopping losses before entering trades. Accepting losses as part of the trading process is essential for psychological health. When you can view controlled losses as business expenses rather than personal failures, you maintain the emotional equilibrium needed for success over the long term. Technology's impact on trading psychology presents both opportunities and challenges. While advanced platforms and analytical tools can enhance performance, they can also create information overload and emotional disconnection from trading reality. Using technology to support psychological development includes maintaining digital trading journals, utilizing performance analytics to identify behavioral patterns, and employing automation to reduce emotional decision-making. However, relying too heavily on technology can become problematic if it replaces critical thinking and emotional awareness. The key is using technological tools to enhance your psychological skills rather than substitute for them. Maintaining motivation and focus during challenging periods requires specific strategies for dealing with inevitable setbacks and maintaining perspective over the long term. Embracing the journey that spans the long term helps you maintain perspective during temporary difficulties. Every loss becomes a learning opportunity, and every win builds confidence for future challenges. Setting realistic goals and celebrating small victories keeps motivation high during difficult periods. Focus on process improvements and consistency rather than just monetary outcomes. Creating a vision of success provides motivation during tough times. Visualize yourself as the disciplined, focused trader you want to become, and use this vision to guide your daily actions and decisions. Avoiding burnout requires maintaining balance between work and life, taking regular breaks, and prioritizing mental health through proper rest, exercise, and stress management techniques. Building a strong support system enhances your psychological resilience and provides external accountability for your development goals. Mentorship provides access to experienced perspectives and wisdom that can accelerate your psychological development. A good mentor helps you recognize blind spots and navigate challenges more effectively. Networking with other traders creates a sense of community and shared experience that reduces the isolation often associated with trading. These connections provide emotional support and practical insights from people who understand your challenges. Working with trading coaches or psychologists offers professional guidance for overcoming specific psychological barriers. These experts can provide specialized techniques and accountability that accelerate your growth. The path to mastery in trading psychology represents a journey that lasts your entire lifetime of continuous improvement and discovering more about yourself. Mastery isn't a destination you reach, it's an ongoing process of growth, learning, and adaptation. Integrating psychological strategies into your daily routine makes them second nature over time. Consistency in applying these techniques builds the mental habits that separate successful traders from those who struggle. Developing true discipline means following your plan regardless of emotional pressure or market conditions. This discipline comes from understanding yourself, having clear rules, and maintaining perspective on your goals over the long term. Building resilience allows you to handle inevitable setbacks with grace and turn them into learning opportunities. Resilient traders bounce back quickly from losses and maintain confidence in their abilities. The importance of consistency cannot be overstated. Every successful trader reached their level through consistent application of proper psychological and technical principles, not through occasional brilliant trades. Remember that becoming a master trader is about mastering yourself first. If you can manage your emotions, control your impulses, stay disciplined, and build resilience, you will develop the psychological foundation necessary for success over the long term. The journey toward trading mastery never truly ends. Each trade offers an opportunity to improve, each setback provides a valuable lesson, and each success builds upon your growing foundation of skills and confidence. As long as you maintain a commitment to learning and growing, you'll continue progressing toward becoming the trader you're meant to be. The market will always present new challenges, but with proper psychological preparation, you'll be equipped to handle whatever comes your way. Trading success isn't just about making money, it's about mastering your emotions, staying focused on your plan, and building the mental resilience needed to thrive in an uncertain environment. The psychological tools and strategies we've explored provide the foundation for this mastery. Your journey toward trading excellence starts with understanding yourself, continues with consistent application of proper techniques, and evolves through continuous learning and adaptation. The market rewards those who can maintain psychological discipline while navigating its constant challenges and opportunities.